All right, so I think we can start the class now. Proposing a scheme of reconstruction. So without wasting time, you can write something small by saying, this is where the shareholders intends to reconstruct the entity, but they do not have the scheme of reconstruction. They do not have a scheme of reconstruction. Full stop. Down there, procedure for proposing a scheme of reconstruction, or just say procedure for proposing a scheme, or just procedure. Of course, procedure for that, so there's no need of writing so many things. So procedure, number one, determine the expected proceeds. Determine the expected proceeds. Number two, distribute the expected proceeds. In the following order. So you come here and say expected proceeds, U less reconstruction costs. You less the reconstruction cost. So reconstruction cost may be the liquidation, the expected liquidation cost and the rest. Then you less secured credits or creditors. Then whatever remains is available to unsecured creditors. Then you less the unsecured creditors. So what remains is available to shareholders. In fact, I should not close it there. Available to shareholders. Then you less preference dividends. You less preference dividends, including arrears. Then what remains is available to ordinary Of course, ordinary shareholders. So that is the step 2. I hope that is done. Hope that is done. Procedure number 3, step 3. I hope you're done with that. Step number 3. Step number 3. Determine the estimated maximum loss. Estimated maximum loss. Estimated maximum loss as follows. The estimated maximum loss, you will check accumulated losses, the negative retained earnings, preference dividends in arrears, if they have not been paid, will form part of the losses. Decrease in assets, part of the losses. Increase in assets. If there is increase in an asset, that one will reduce the loss. So increase in asset, you subtract. Decrease in liabilities. Decrease in liabilities. That one also you less. Increase in liabilities. Those are part of the losses. Mostly it can arise due to so many factors, but majorly those are the ones you need to consider. So this is the total expected loss. The total expected loss. Total expected loss. Then step 4, determine loss per share. You determine the loss per share. So loss per share will be, loss per share will be total expected loss, divided by the number of shares. So number of shares, it will depend with which shares we're dealing with. If it is preference, you check loss per share divided by the number of preference, common ordinary with ordinary. We'll check that when we're doing the question. So that's how you get loss per share. Then step number 5, any other proposal based on the steps above. So based on what you have checked up here, you can say anything in step number 5. So step 5, I'm saying any other proposal based on the steps above. And finally, step 6, the statement of financial position after proposal. The statement of financial position after the proposal. So you can prepare the new balance sheet after your own proposal there. Illustration. This was, I think, it features there for the first time last sitting from what I was told. Nataka tuiangalie pole pole. December 2023, question 5. Open that question. Open that question. December 2023, question 5. That is last sitting. I hope everyone has the question. Otherwise, we can post. So, allow me to read the question. It says, for a number of years now, A Limited has been reporting operating losses, principally due to competition from firms operating in the same sector. A Limited is now considering reorganizing its operations and financial structure to allow it to obtain new fundings required to develop and launch a new product. Technical experts have indicated that the new product will do well in the market once it is launched. The statement of financial position of A Limited as at 31st October 2023 is as follows. So as you guys can see, that was the balance sheet. Additional information. 1, preference dividends have been in arrears for 3 years. The retained earnings balance is to be eliminated. Eliminating retained earnings means it is accumulated loss. The following details relates to the assets. 1, tangible assets, 15% of the book value is to be transferred to the bond holders for an agreed value of 720 million in full settlement of the debt, and the remaining book value of these assets marked up to 110%. Inventories include obsolete items worth shillings 540 million below their value of shillings 680 million. A bond investment having 10 years month to maturity date is to be revised to shillings 280 million from its carrying value of 370. Receivables with a carrying value of 1,200 million are to be factored out for 70% advance, and terms that will allow for refund of any difference between actual collection and the upfront payment from the factor. One customer who owes 828 million is in serious financial difficulty. Only 50% is expected to be received from this customer in 1 year's time. Number 4, the bank has demanded repayment of the bank overdraft, while finance institution has accepted to receive 92% of their existing loan in new ordinary shares as full settlement. Upon successful completion of the reorganization process, however, the finance institution is ready to immediately buy 15%, shillings 900 million, debentures in the reconstructed entity's debt, provided that the directors will attach the rights to convert the debt into shares at maturity. The finance institution will also require 10% discount on the convertible debt at issue, and estimated to be repayment 3 years. Repayment period of 3 years. The effective rate of interest on this convertible debt, if the discount is granted, is estimated to be 18.7%, and the effective rate of interest on the equivalent non-convertible instrument will be 22.5%. Existing ordinary shareholders are prepared to inject shillings 4,200 million for 840 new ordinary shares, while preference shareholders are pledged to finance new production equipment whose estimated fair value is shillings 1,350 million. Each of these shares currently have a value of shillings 5. Let's proceed. Number 6. Half of the trade payable suppliers have agreed to be paid using ordinary shares in the reconstructed firm. A firm order has been received from BB Limited, a competitor, to buy all the business assets for 7,200 million. Assume a discount rate of 15%, unless a difference rate, 60% of the proceeds relates to tangible assets. Closure costs are estimated at 50 million. Assume a discount rate of 15%, unless a difference is more appropriate. The present value of shillings 1 receivable at the end of the year for different discount rates is provided below. So year 1 to 3 at 10%, 15, 18.7, 22.5. Required, suggest a scheme of capital reorganization that will be acceptable to all stakeholders, including a revised statement of financial position. Hiyo kitu inaweza kuuma kichwa bure. Hata kichwa inauma already. So what you do, This one looks, it was quite crazy, especially for students. Even here it is crazy. We try to procedure and it won. But now, the good thing, when you follow the procedure, becomes out clear. So when you want to propose a scheme of reconstruction, number one, what we have said, you need to determine the expected or the estimated maximum loss. So check what is the expected, not loss, sorry, the proceeds first. You check how much proceeds we expect, the expected proceeds, you distribute, then you go to loss in that order. So let's just kick off by saying expected proceeds. Expected proceeds. So expected proceeds, shillings are in millions. You check from your assets. You know, you want to propose. Check the assets. How much can we get from the assets? That one I saw it somewhere. Check note number 8. Check additional information number 8. A firm order has been received from BBI, Limited, a competitor, to buy all the business assets for 7,200 million. 60% of these proceeds relate to tangible assets, closure cost. So someone who is willing to buy all the assets at 72. So those are the expected proceeds. So you come here and say, tangible assets, 60% of 72. So what is 60%? What is 60% of 72? Somebody? %. Let me open the chart section. So 60% of 72 is 43.20. It means the remaining assets, so other assets, the difference, 40% of that 72. I'm a student akichukua tu from assets, uandike 72 at once, there is no problem. Ungechukua tu 72, but I'm just trying to split for reasons which even I don't know. So 40% of 72, the difference is how much? 20 something. $28.80. So that one gives us 72. That's why I'm saying somebody could have just written 72 without any problem. Then, so this is the expected proceeds. Then you distribute. So right there, distribution. So when carrying out distribution, when carrying out distribution, you start with yourself. Wewe mwenyewe una propose the reconstruction, cost, which here I saw them calling it closure costs. So we check in which note, how much is how much? I saw it somewhere down there. The closure, they call it closure cost. That is what starts. It was how much or in which note? Somebody? I want to engage you, each one can come by. So we have to engage each other and we're quite interesting. Closure cost was how much or which note? Silao 50, Brandy 50. Uko chini somewhere. So it's down. In the same note. Note 8, thank you. Closure costs are estimated at 50. So this is the first thing you're supposed to pay. That's the first thing you're supposed to pay. Then you go to the balance sheet up there, check any secured creditors. Is there any creditors are external liabilities? Actually, in your schedule, liabilities, secured liabilities. Which liability was secured? Can you go to the liability section in the balance sheet? Tell me if there is any which was secured. The ones which are secured is the one you pay first, then you remain with the unsecured. Was there any liability which was secured? Secured means there was a collateral on it. Is there any on the liabilities before I check? Yes, I can see one. People have seen it, yes. One, the bank overdraft was secured. So it was 39. So that one must be settled first from the proceeds. So bank overdraft, bank OD, secured. So that one must be settled out of what is available, 39. So what remains after the secured and the cost is available. So available to unsecured liabilities. How much? 72 minus that. How much remains available? $32.50 running. So $32.50. Then now let's check the unsecured. Unsecured has now all those liabilities remaining. So we have 20% bonds. So there is 20% bond. This is 750. We have payables. Payables, 1968. We have after bank overdraft. Down there is loan from financial institutions. So financial institutions, 925. So these are unsecured. So how much? This plus this plus this. Add for me the three, which are unsecured liabilities. 30, Gideon 3643. 3643. What is available is 32. So it means here we will only get 3250. Yes, unsecured total is 3643. They are losing, they will lose. So maximum we can get is 3250. Therefore, available to shareholders. Available to shareholders is nil. Available to shareholders is nil. There is nothing. Because at our delivery. So that is the first step. So from ukifika tu hapo, when I examine at least somewhere. Just knowing how to distribute that is a plus. So finish that. Then now, after getting this, we want to check maximum expected loss. What we have done here is just checking what we can receive and how we can pay. But now what is the loss we can, we are likely to encounter. So right there, step 2. Step 2. Step 2, maximum expected loss. Hope everyone is done. Maximum expected loss. Step 2, maximum expected loss. So maximum expected loss Start with the accumulated losses, which is the retained earnings. So we are adding, you add all the losses together. If there is something which is a gain, you subtract the gain to reduce your loss. So you add all the losses together, but if there's a gain, you subtract. So accumulated losses is the negative retained earnings. So negative retained earnings. Those are what we call accumulated losses. So go to the balance sheet. How much are you seeing? How much is our accumulated loss? 29.18. People are saying there. Yes, true. 29.18. That is loss number one. Then another loss are the preference dividends in arrears. As in case of anything, hizo zitapotea. So it will be a loss to the preference. So preference div in arrears. Preference dividends in arrears. Go to the balance sheet. Go to the balance sheet under equity. We have 20%. They were paying at 20%. So 20% times 1,500. Preference 1,500. Then it was in arrears for how many years? Which note do we check? Pole pole tu. Note number 3, Gideon. Oh, 3 years. Yes, not 1. Correct. The preference dividends have been in arrears for 3 years. So times 3 years. So how much was in arrears? How much was in arrears? The total value in arrears, which is part of the losses, 900. So 900, you top up. Then now let's go to the notes. Tunasoma tu tukijaribu kuangalia if there is anything. So to the notes, note number 1, done. Note number 2, retained earnings balance is to be eliminated. We have captured. Note 3 says, tangible assets, 15% of the book value is to be transferred to the bondholders for an agreed value of 720 million in full settlement of the debt, and the remaining book value of the assets marked up to 110%. Wow, there is something we have to be very keen on. So tangible assets 15%. Yeah, let's just be in real life to see usiangalie sana kimasomo. Let's just bring it to reality. We have an asset, the tangible asset here, let's call it even a motor vehicle. So 15% of the book value of that motor vehicle, we are going to use it to pay the bondholders. Major bondholders, they were kuna deni zao. So they will accept that value to the tune of 720. So we need to check what is 15% of the book value of the tangible assets. Can you do for me that math? 15% of book value of tangible. Makasi says 750. Tangible assets was 5,000. 5,000 by 15% is 750. So they are transferring an asset with a value of 750. Taka tuelewe hapo. Tuseme motor vehicle yetu iko na value of 750, but we are using it to settle a bond, but they are accepting it for a bond of worth 720. Get that clear? So it's like to them, they are revaluing down. They are revaluing down our assets because our asset has a value of 750, but they are accepting it at 720. So it means our asset has lost value on transfer. When we are transferring, it has lost value. On the other hand, we have reduced a liability because bondholders need it. Now, I'm in full settlement. So we have reduced the liability and also our assets has been reduced. So it will have two implications. One, tangible assets transfer. So on transfer, 750 minus 720, then we have lost. I'm going to make it the other way around, whichever. Provided you understand, when we transfer, is a loss to us. It's like our asset has been devalued to the tune of 30. Then the bond, decrease in bonds, decrease in bond, the 750 minus the 720, so that 30. When a liability goes down, here we are going to credit the assets, then we debit the liability. Decrease in liability is a debit. So you decrease a liability, that is like an income. If you check it on the other side, it's like, again, to us, when you reduce your debts. So this one is like an income, so we use it to reduce. So at the end of the day, it will cancel out. So the asset has decreased, liability has also decreased. So the decrease in asset, that's like a loss to us, which you add. Decrease in the liability is like an income which you reduce. That hapo waleta maneno mingi. Then in the same note, in the same note, they said, there's something I saw. In full settlement of the debt. And the remaining were marked up. The remaining were marked up by 110%. The remaining assets were marked up by 110. It is always, everything is at 100. So marking up by 110, it means there was an increase. So the increase for the remaining. So increase, you can say increase in value, remaining tangible assets. So the remaining tangible assets increased to value by 10%. You see, when you say 110, the increase is just that 10. So the remaining, first of all, we have to agree it is 85%, because 15% is what we transferred. So the remaining will be 85. So 85 of 5,000, because tangible was 5, times 10%. 10% is the increase. Ukienda 110, itabidi we subtract. We take 5,000 minus. So hakuna wende 110. You see, if you go to 110, now you take the difference, 110 again minus, which will be long process. If you take 110, then make sure you subtract 5, which will take you a long way. So just work with the 10% increase. So the remaining is 85% of this, then 10% of that, it increased with that value. How much is that? How much? Thank you, 425. So that increase, increase in value of asset is revaluation. So it will reduce the expected losses, kindly. We proceed. Now we are in note 3, bullet 2. Note 3, bullet 2. Inventories include obsolete items worth 540 million below their book value of 680. So inventory, that obsolete is what you take, that's the loss itself. Obsolete is the loss, 540. The obsolete is the loss. Number 3, bullet 3. A bond investment having 10 months to maturity is to be revised to 280 from its carrying amount of 370. So bond investment all the way from 370, it be reduced to 280. How much is that? That's the difference, the loss from 370 to 80. The loss is the difference. which is how much? 90. So that is also a loss. We are proceeding. Number 3, bullet next. Receivables with a carrying value of 12 are to be factored out for 70% advance under terms that will allow for refund of any difference between actual collection and an upfront payment from the factor. Here in Ashida, they are saying receivables with a book value of 12 are to be factored out for 70% advance. Advance meaning customers on our pay pesa even before delivery. So there is no loss there at all. So that one, there is nothing. One customer who owes 828 is in serious financial difficulty. Only 50% is expected to be received from this customer in 1 year's time. So kuna customer akona deni ya 828. We can only receive 50%. It means that the rest will be bad debts. So bad debts, so receivables, bad debts. Only 50% will be received in 1 year's time. 1 year's time, for now, you discount. You have to discount to present value. So what we expect to lose will be 828 minus what we expect to receive. We expect to receive 50% of 828, but in the next 1 year. So in a year's time, you discount to present value. So go to the table down there, number 10. Which cost of capital do you think we should use? There is 10, 15, 18, 22. Which one should we apply for this? Which cost of capital do you think we should use? Which percentage? And I'm discounting because this one will be received in the next 1 year. So I have to bring it now. Which rate do we use? Somebody? We are going to use the rates in note number 9. Assume a discount rate of 15%, unless a different rate is more appropriate. So hapa wanasema any rate. So where no rate has been mentioned, 15% is applicable. So you take 15% year 1. 15% year 1 is 0.87. So times 0.87. Round off to whole number. Round off to whole number, whatever you get. So this is what we expect to receive in the next 1 year. So expected in the next 1 year. So huyo customer kwa deni yetu 828, we only expect to receive a half, but in the next 1 year. For now, you have to discount this to present. So 0.87 is 1 plus R raised to power negative 1, where R is the 15%. So 1.15 raised to power negative 1 is the one giving us this figure here, multiplied by this. So this is expected to be received. So irrecoverable debts will be the difference between the total minus what we expect to receive. What do you get, ladies and gentlemen? What do you get? You can round it to a whole number. Yvonne and the other person 468. So this is 468. That one is also a loss, which you add. Let's continue to see if there is something. We are done with number 3. So we are going to number 4. We are going to number 4. The bank has demanded repayment of the bank overdraft, while the financial institution has accepted to receive 92% of their existing loan in new ordinary shares as full settlement. Correct. So financial institutions, they have accepted 92% for full settlement. It means 8% hatutalipa. So that one will be income on our side. So we need to bring it here. We need to bring it here. Loan from financial institutions. Loan from financial institutions. They accepted 92. It means they will lose 8. The loss on their side is again, so that's again on our side because with them they are losing. So 8%, what was the figure for financial institutions? The loan, how much was the loan? Check your balance sheet. How much was the loan? Check balance sheet. How much was the loan from the financial institutions? $925. Correct. Down there. It is $925. Is the last item in your balance sheet. Feature mahali hapo. So 8% our hatulipi loan. So if you're not paying the loan, that is not a loss to us, it's an income on our side. So it will reduce the loss. So 8% of 925, 74. So this 74, you reduce. We are continuing. Upon successful completion of the reorganization process, however, the financial institution is ready to immediately buy 15%. Hapo sikuona anything. There is nothing there. Hiyo tu ni after. Whatever is there, ni after. Number 5, existing ordinary shareholders are prepared to inject 42 for 840 new ordinary shares, while preference shareholders are pledged to finance. Those ones are happening after. Number 6, a half of the trade payables have agreed to be paid using ordinary shares in the reconstruction firm. There is nothing serious there. There is nothing serious there. Directors have projected annual profits. Affirm number 8, tulishafanya discount rate kwisha. There is nothing. So the maximum expected loss is this much. These others from number 5, ni kama is after. So after reconstruction, that is none of our business. So how much? How much is the expected loss? So this is the expected loss. Wewe usione ni ngumu. Tumeenda tu procedurally. Kwa mtihani ndio ukiweka 2 na kuna mtu mwingine ameweka, wewe ndio uko number 1. Hata ukiweka hii moja na kuna student mwingine alikumbuka hiyo moja, you are number 1, so you are just okay. So you just master the ones you can. Ni ngumu kwa kila mtu. So why am I subtracting like this loan? Wamesema tukitulipa 92 tuko sawa. So we are gaining. So that cannot be a loss to us. Receivables, a half nitalipwa, but after 1 year. So we discounted this one. I hope I'm doing these things the right way. Yes, that is the right way. In the next 1 year. Nipe total. Tutafika huko mwisho tuone. Who has a figure? Makasi 4417. Somebody to confirm. One person. Gideon 4417. So that is the maximum expected loss. So whenever there is expected loss, the people to suffer are the shareholders. Shareholders, this is ordinary and preference. So this loss, you have to distribute it. Distribute this loss to the shareholders. So you can write down there actually. The expected loss the expected loss should be distributed to preference and ordinary shareholders. Should be distributed to preference and ordinary shareholders in the proportion of their shareholding. In the proportion of their shareholding. Proportion of their shareholding. So check equity, we check their proportion. So in equity, so down there you say preference shares, ordinary shares. Check under equity walikuwa na ngapi ngapi. So they had preference was 15. This one was 4. So total is 55. Meaning that preference will go with 15 over 55 times the total expected loss, 44.17. Ordinary will go with 4 over 55 times 44.17. So that in your new balance sheet, you will subtract whatever they have lost. So can you distribute for me those two losses? Give me the two figures. This one and this one. Let's round off. Give me the two losses. This question was very difficult from what I can see. Brand 1205. Then our wengine wanasafa 3212. So in your new balance sheet, you'll reduce their capital with those losses like that. Haya, so ukishafika hapo unaandika tu other proposals. Other proposals, we are almost now going to the new balance sheet, but unacheza tu na wao hivi tu. Other proposals, you can write, napo pia unaweza ponyoka by the way without even this calculation, unaweza pata kitu. These other proposals, you check how the question has been designed, but there are some which are standardized. Like number 1, you can say accumulated losses. Kama umechoka na the word accumulated losses, you can call it number 1, deficit retained earnings. Deficit retained earnings are the accumulated losses. Deficit retained earnings is the accumulated losses to be eliminated. So now you're advising them on the proposed scheme. Deficit retained earnings to be eliminated. That is quite obvious. Everyone else knows that. But now, yeah, that is standardized. Then you can play around with the notes For example, when you check note number 7, check note 7, the directors have projected annual profits. Sorry, not note 7. Note 5. Yeah, note 5. Existing ordinary shareholders are prepared to inject shillings 4,200 million for 840 million new ordinary shares. So that one you say existing ordinary shareholders to subscribe for the new issue. Of course, because already they have said that they are paying for the new shares. So you just tell them they need to subscribe for that, which is quite obvious. Read the same note. Read the same note. While preference shareholders have pledged to finance new production equipment whose estimated fair value is 1350 million. Each of these shares currently have a value of shillings 5. So, number 3, preference shares to be converted into ordinary shares. Be converted into ordinary shares. Then maybe finally, the assets. During a reconstruction, assets should be adjusted to their correct values. So maybe you tell them number 4, assets to be. Usitumiage the word adjusted. Okay, you can use, but to make it more weight, you say assets to be restated. Restated to their fair values. Fair values are the market value of the assets. And I assure you, without even those computations, this one here, examiner anaweza not kupatia kitu kama hata 4 marks, ama hata 3, without the computation. Then you go to the balance sheet, akupatie kama 10 marks. So you end up getting 13 over 20. Then ingine umepoteza kila kitu. But now you see, hiyo ingine pia unapambana kidogo tu, kwenye imekuwa ngumu unaachana. Provided you know the procedure of proposing a scheme. So from here, we need to give them now revised balance sheet based on whatever we have proposed here. So in the revision, there are some items which I think are going to change drastically. Number 1, ordinary shares. There will be quite a number of changes in the ordinary share capital. And which one can be my concern? Bank. I think those two. Those two, we need to make some small adjustments. The bank and ordinary. So allow me to, let's do those 2 workings before we go to presentation. Start with the presentation, then we'll do kwanza. Just check note 4. There's something small in note 4, which we need to break down. Then we reconcile ordinary and bank. Kwa mtihani hata usingangane, unaweza hizo mbili. Kuna marks mingi utapata hapo ndani. Hii students waliumia. So when you check note 4 has a lot of issues. The bank has demanded repayment of the bank overdraft, no problem. While the finance institutions have accepted to receive 92% of the existing loan in new ordinary shares as full settlement, no problem. Upon successful completion of the reorganization process, however, the finance institution is ready to immediately buy 15% shillings 900 million debentures in the reconstructed entity's debts, provided that the directors will attach the right to convert them into shares at maturity. The finance institution will also require 10% discount on the convertible debts at issue and repayment period of 3 years. Well, the effective rate of interest on this convertible debt, if the discount is granted, is estimated to be 18.7%, and the effective rate of interest on the equivalent non-convertible instrument will be 22.5%. Kizungu mingi. What they are saying is that the finance institution, wamesema tukiconvert, if we go to new company, we'll take up 15% debentures in shillings 900 million. So expected, how they're working one, debentures, annual interest will be 15% of 900. That is what they are, we make that provision immediately. So what is 15% of 900? 15% of 900, 135. So they are saying we want to receive 135 for every year for the next 3 years. So you will come here and say year 1, 2, 3. Then the cash flow is the 135, 135, 135. Then again, have another year 3. Have another year 3. That one I'll tell you later. So present value, interest, annuity factor. We use the factor for similar bonds or similar securities. So similar securities was at 22.5. Check that, please. Was at 22.5%. So you go at 22.5, year 1, we have been given in the table. So check the table under 22.5. So 0.82, 0.67, 0.54. So the discounted cash flow, which is now the present value, can you give me the 3 figures? Let's round off to whole numbers. The 3 comes to 111, 91, 73. And then year 3 is the redemption. It was 900. So year 3 is points. Redemption now the principal. This was interest. Then the same year 3, there is the 900 for the principal. So this by this, what do you get? That one comes to 486. And the total value of the debentures. That should be the total value of the debentures. What should the value be as of now? What will that value be as of now? As of now. Though here I saw some people getting 90, I don't know the impact it will have. It comes to how much? $761, $760, which is which? This was it 91 or 90? This one here. So many people saying 90. I don't know. Was it 90 or 91? Let's clear the air, mapema. I'm seeing 90. So if it's 90, then this one will be 760. 760 is the value of the bond if you consider the present value right now. But issue value at discount. They were given at a discount of 10%. So they were given at 900 times 90. That is what the examiner said. They were given at a discount. Well, you know, redemption, you redeem the principal value. Interest is based on the nominal. You manually a discount, that is where you lose, you gain. So when you want to check the gain loss, is when you bring now the discount element. So 90% of the 900, that one will give you 810. So they issued the debentures at 890. Taking the value for money to consideration, we are talking of 760. So these people, they have gained because the value has gone down. So that gain, if you remember the yesterday's question we were doing in reconstruction, the other question, that gain is equity. That is equity component. That difference here. The difference between the discounted cash flow and the actual is always the equity, because they are playing around to raise capital. Of how much? The difference between the two? 810, 350, yes, 50. So tukienda kwa balance sheet and equity, please remind me of this 50. Hey, I hope so. I just hope so. But this one really disturbing people. This is IFRS 9. This is about IFRS 9 concept. When you discount the cash flows, then you compare with the actual. The difference is always the equity part, which goes to the balance sheet under equity. Allow me to reconcile ordinary share capital and bank. Only those two. Then we do the balance sheet, then we are done. So we start with which one of those two? Which one would you want us to start with? Ordinary share capital and the bank account, because those two have seen so many changes. Which one would you want us to start with? Of those two? Tuanze na gani? Ama tuanze na presentation, then those ones we can forget about them. But that will not be the right way, because I also want to see our accuracy. Silence means we start with any. People have said, let's start with ordinary. So, let's start with ordinary share capital accounts. We check those changes. Let's check the changes in the ordinary share capital account. Ordinary share capital. Then we reconcile the bank. Then we do presentation. Then you sleep. We start. Balance brought down. I remember it was 4,000. Check your equity there. It was 4. Nakumbuka tukifanya apportionment pale. It was 4. Then there was reduction due to the expected losses. How much was the reduction? You debit. The reduction you debit. So capital reduction due to the expected loss. It was how much? Ordinary went with how much of the loss in the reduction? Ordinary went with the loss. Ordinary carried what figure? I remember they carried the highest, 32.12. So they went with 32.12. Ordinary went with 32.12. So you reduce by debiting the ordinary account. Because remember, share capital is a credit, reduction, you bring it here. Now, let's start now checking. In fact, now this goes to you. I want you to check any note. Kama kuna note umeona tu ni kama inaguza ordinary, you tell me mwalimu check note. Kama ni note 3, unasema note 3, note 3, 1, note 3, 2, ama note 4, hivyo. Can you just check across? Because nikisoma peke yangu nitachoka. Can you just check across? We are many when we check, all of us, to be easier. So can you just check them, tell me to check this note, check this note, check this note. Which note do you feel affects ordinary share capital? Once you say we check, then we proceed. Somebody. Note 5. Makasi has said, so waja mpaka tumalize na Makasi ndio tuende kwa next, please. Mtu asilete ingine. So note 5, existing ordinary shareholders are prepared to inject 4,200 for 840 million new ordinary shares. So that is cash. You credit, shares are going up. So cash, thank you, that is true, 42. So similarly, the bank account will be debited with that 42 later on. So note 5 taken, another note. Note 5 taken. Next note, maybe which you have seen. Brandy said, let's check note 6. Note 6, half of trade payables have agreed to be paid using ordinary shares in the reconstructed firm. I agree. So payables, a half wanapewa shares. So check payables up there. Trade payables, 1968 by a half. 1968 by a half. What is 1968 by a half? What is 1968 by a half? $1968 by a half? 984. So you have given me note 5, note 6. Next, which someone can see, if any which somebody can spot somewhere. Hata kama iko correct wewe sema tu, nitakuelezea kama iko correct, tunasoma tunachambua, unaona whether it was not supposed to be. Any note which you feel should be factored? We have taken note 5 and 6. Which note? Which note? I'm giving you a whole 1 minute to check. Because I feel still there are some. There were many. Note 4. We have been told by one to check note 4. Note 4, the bank has demanded a repayment of the bank overdraft, while the finance institution has accepted to receive 92% of the existing loan in new ordinary shares. Correct. So the finance institution they want 92% to be shares. So finance institution is going to be 92% times, it was the last item in the balance sheet, 925. 925. So what is 92% of 925? $851. Thank you. Let me bring in some, which I think might bring issues. We said preference shareholders to take up ordinary. So convert the preference shares. Mostly when we are facing financial challenges, this is in a longer standardized. Number one, talk to those people to go to ordinary so that we suffer together, so that they don't become preferential. Kila sawa nataka kulipwa dividends, talk to them. So hata kama hujaambiwa, when we are proposing a scheme, rule 1, preference shareholders are to be converted to ordinary. That must be your first proposal. So preference, so when you convert them means you increase the ordinary. So what was the value? What was the value of preference shares capital? Hapo juu. It was, when you check, you will see 15. Yes, it was 15, but we reduced. So you subtract. We reduced it by how much? You have it there, pale kwa loss. Preference was reduced by how much? Preference was reduced by how much? Randy, 1205 plus, check this note here. Iko wapi? Check note number 4. Von, your note 4 down there. Where they were saying, upon successful completion of the reorganization process, however, the finance institution is ready to immediately buy 15%, 900 million debentures in the reconstructed entity's debts. It is really that. There's this one talking of preference. Which is this note? There's a note somewhere there, note 456, talking about preference. Let me just look for it. When you see it, you let me know. There is that note which they were killed. No. In note 5, but that is something different, which I'm going to treat separately. What I wanted to bring in is note 1. Yeah. Preference dividends have been in arrears for 3 years. So when you are converting, you convert their capital plus arrears which they have not been paid. So I'll take 15, which is capital, minus the reduction plus the arrears. How much was the arrears? You have it somewhere. Preference dividends in arrears. How much was it? 900. So indicate here, these were the arrears. So we are converting. The rule is when you're proposing a scheme, preference must go to ordinary. Your company liquid na kulipa dividends meaning. So the total minus reduction plus the arrears, how much? How much will that be? $11.95. Finally, we are remaining with 1. Finally, note 5. Note 5. Existing ordinary shareholders are prepared to inject 42. That is taken. While preference shareholders have pledged to finance production equipment whose estimated fair value is $13.50. Each of the shares so why are they bringing equipment? You know, asset yako kwa kampuni, that is your capital. So the equipment by preference, we will debit the equipment account, then we credit their capital account. So equipment by preference, 1350. That is part of their capital they are bringing in. You can bring capital in form of cash or assets. Therefore, ordinary balance carried down, which will go to the balance sheet, is how much? And then cash book peke yake, then we are done. We do the balance sheet. So, what will be the balance carried down, ordinary? Moha. Hapana, hawajaiseti kitu. The first billion waliseti kitu was back in 2008. I don't know, 20 years, like 20 years ago. Hawajai examine hii kitu. So we pambana tu na hii peke yake, because I'm sharing the recording. No, I will give you the recording. We rudia mara mingi. So you should not worry you. Oma tujiconsole juu ilikuja yezi kuja tena sahi. 9368. I don't have any other question, to be very honest. But I remember those procedures which we are doing. Let's reconcile the bank. So let's have bank accounts. I hope everyone is done. I want to wrap this. So I have the bank stock cash book, balance brought down to let's say this one here. The 42 we debit in the cash book. Then we check 1, 2. So have the cash book there or bank. So cash book, balance brought down. I remember it was an overdraft. So bank overdraft, it was the balance brought down. Check overdraft from the balance sheet. So from the balance sheet, bank overdraft was 39. Then I remember ordinary share capital, the 42. That one I remember even before reading. Then there are some 2 which I need to check. I remember there are some 2 which are marked during reading. Check note 3, bullet 1, 2, 3, 4. Bullet 4 of note 3. Bullet 4 of note 3. Receivables with a carrying value of 12 are to be factored out for 70% advance under the terms that will allow for refund of any difference between actual collection and upfront payment. So advance, it means tunapewa sahi. So factoring, whichever name, factoring of receivables, advance, I'm going to call it advance, whichever, 70% of 12, that is 840. They factored receivable of 12 for an advance. So advance means they are getting it right now. Correct. Then, you remember the debentures, the 900, that was in note 4. You know, debentures, the pesa unapata. Note 4, where they were saying, that finance institution walipea, hebu soma note 4, uko chini si hapo mbele. Ama tusoma yote. The bank has demanded repayment of the bank overdraft, which we have credited, while the finance institution has accepted to receive 92% of the existing loan in new ordinary shares, we factored. Upon successful completion of the reorganization process, however, the finance institution is ready to immediately buy 15% shillings 900 million debentures in the reconstructed entity's debt, provided that the directors will attach the right to convert it into shares at maturity. The finance institution will also require 10% discount. So debentures, they will pay but at a discount, 900 times 90%. This one we got 810 somewhere. They will pay 810 because of the discount. There is nothing. Give me the balance. There is nothing for the cash book there. Well, you know, working is busy for the committee. It has a balance, but you do good presentation. Give me that figure, then we can do the presentation. Presentation cannot take us 10 minutes or 10 minutes maximum, so we'll be done before 8 to allow you to prepare for tomorrow. How much is that? $19.50. How? So right there, wanajiita nani? A limited revised statement of financial position. A limited revised statement of financial position as at (31st) will it be 31st? Itakuwa 1st November 2023. Because 31st was the old balance sheet, so after revision, the date will change. So we can have here shillings in millions, but we are ready. Non-current assets. Ama represent yes. Non-current assets. Tangible assets. So just flow with this one of theirs. Tangible assets. You remember what happened? 15%, unakumbuka 15% exchangewa na debentures worth 720. You remember the 15% somewhere there. So we remained with 85%. Then this 85% was topped up by what percentage? I just want to check whether we are together. The remaining tangible assets was topped up by what percentage? If you can recall without going down there for reading. Yeah, by 10%, correct. Which they said 110. So I'll take the remaining 85. 15 they used to pay the loan. So 85 of 5 times 110. This time around I will just go for 110 because the 10 is the increase. Then again you add, which will be a long process. So here you take the 110 to increase it at once. Plus, there was equipment. What was the value of equipment which preference shareholders brought? There was equipment preference on the letter. It had a value of how much? There was equipment preference shareholders brought in. Yeah, 1350 to stand by. So they brought in 1350. So capture this, then you add 1350, then you tell me the answer. 60, 25. We proceed to shikilia tu hiyo yao, lakini the one which was not affected, financial instruments, there was no effect. So post. Financial instruments, there was no effect at all. 1,000. So na hiyo ungepata hata kama wewe unajisumbua na vitu mingi. Hiyo mtu angepata. Haya. Current assets. So niandike hivi kwanza, andika hivi. Cash book we have gotten 1950. Then other current assets. Other current assets. So others, tuchukue hii sasa 41.25. But there has been some issues. Remember, current asset, there is inventory, receivables. So inventory, there was a decrease. Receivables, there was bad debts. So we have to subtract those ones. We adjust. So of the 41.25, let's go to note number 3, bullet 2. Inventory include obsolete items, 540. So minus 540, obsolete. Next. A customer 828 is in serious financial distress. Ili tuli discount pale the bad debts. Hebu check for me. Pale kwa expected loss. It was how much? There is, we took 828 minus, I don't know, 50%, something. What did we get? You have that figure. The bad debts. 468. Please indicate in your books where you are getting the 468. Kindly indicate for me where you are getting the 468. You say it is the bad debts, because you know you can look for it mpaka ikulete shida. Then a bond investment is to be revised to 280 million from its carrying value. Well, I think hapa kuna shida. No. 10 months to maturity date. Yes. Hey, there is an issue, but you will really try to understand it with me, because huko kwa inafikiria yale fai kwenda hapo. Read note 3, bullet 1, 2, 3. Bullet 3, a bond investment is to be revised to 280 from its carrying value of 370. So there is a loss of 90. We even captured it up there. So the question is, make it open. Something is telling me to subtract it here. Something is telling me also to subtract it for financial instrument. Bond investment. What do you think? Because that loss must be we must let it off. Should we subtract it from the financial instruments, or should we bring it here? What is your thinking? Let's just bring it up. That loss on bond investment must be subtracted. So should we subtract it on the financial instruments, or we subtract it on other current assets? What do you think? I'll tell you what I'm thinking, but tell me what you think first. Ama tuachane na. The fact remains, bond investment is an asset. So at least we must net that loss. Karen thinks it should be under financial instruments. Karen, you know, that was my thinking initially, but you see the financial instruments, they have captured it under non-current if you check the balance sheet. So what made me to rule that out, they said in brackets, having 10 months to maturity. So 10 months to maturity means the short term, less than 12 months. So Karen, I hope you agree with my thinking. Less than 12 months is a current asset. So it should come under other current assets. Otherwise, if the 10 months was not there, then I will subtract it under the financial instruments up here. But you see financial instrument, yes. So that loss, subtract it here. Please clearly indicate in your books what this 90 is. This one is the so this 90 is the loss in value of bond investment. Loss in value of bond investment, which is note 3, bullet 3. So this minus inventory, minus receivable, minus loss in value of bond investment. How much? Then we are done with the assets. You will give me the total assets here. Total assets. Total assets. How much is the other current assets? Customers sometimes are not serious now. How does it go right direction? But at least idea you can buy. How much we are tired? Bring the figure. $30.27 with a total of total assets $12,002. $12,002. That is what we have to proceed. Equity and liabilities. Equity and liabilities. Ordinary share capital. Check for me the account. What did we get? The balancing figure in ordinary share capital account. Ordinary share capital account. What was the balance carried down? What was the balance carried down in the ordinary share capital account? 93.68. Then, when we discounted the debentures, there was excess of 50. So that's equity. Equity option 50. When we discounted, you remember when we discounted any moment you discount financial instrument, then you realize there's a variation with the actual proceeds. That difference is always equity. So here we are talking of 94.18. We are talking of 94.18. Non-current liabilities. That's debentures, 15% debentures. What was the discounted figure? The total discounted. Tulipata ngapi? The one we subtracted, then we got 50. What was the discounted? That discounted is always the actual value, the present value. How much was it? How much? How much was the discounted value for the venture? 760 billion. Current liabilities, payables. Payables, you remember 50% walipewa shares. So you only consider the balance. So payables, 50%, half. Half was given shares, so I only consider half here. So half payables, 1968. What did we get? Half of 1968 we got? A half of 1968. Hiyo swali mtu anaweza taka kuanza kujia kwa class. 1968 by half. 984 brand. 984. Overdraft tulishaweka kwa cash book. Loan from financial, hiyo tulimalizana, hiyo mambo yao ya loan tulimalizana. So that is all. However, there is something. No, in accounting that is okay. You remember receivables. There is an advance payment they got. Advance payment means they got before delivering the service they sold goods. So whenever you receive advance payment, that is a liability. Because signing kupatia pesa na hujaniletea, you are supposed to sell for me a computer. Then I give you money. That is not your money, that is my money. So it's still refundable. So even if it's not balancing, that is something I will bring here. As you were reading, I captured that. So advance factor, I remember it was 1200 by, ilikuwa 1200 by 70%. 70% of 1200. This is 840. When you advance, that is a liability because that is not your money. You have an obligation to refund when you get advance payment. So total equity and liabilities, can you add? If it's not balancing, we say we have tried. But if it's not balancing with something small, we can check what it could be. But just add to confirm. Running 12002, that is okay. So we are very much correct. So without even struggling with all those proposals, so the whole thing gives you 20 marks. Hapa, student angepata hii. Without struggling again, student was to get this one. Even this one, any moment we see advance payment, that's a liability. So, but let's rule out that one. I can tell you for a fact, students most likely when you wako hiyo swali unasema let's approach it the way it is, walipata hizo mbili. Now ni watu walipita. So you cannot just give a question because it is very difficult. But now that you have known how things have moved, you just rewrite that question like 20 times. Ikuja kwa mtihani, you will not come out as if the way you could have without doing that question. So where revise na hiyo, I'll share the recording, you can utilize it where you don't understand where the figures are coming from so many times. Otherwise, the next time we are meeting, right, for me there, group accounting. So our next topic is on groups. So group accounts. Group accounting is our next topic. Group accounting is our next topic. So thank you. Do have a good night. We'll meet in our next class. Thank you.